Good morning, everyone. I'm going to give it just another 30 seconds here. We still have a lot of people joining in.
Angie?
Yes.
My name is Bill. I was wondering, are you going to be showing slides on screen, or are you only just going to be talking?
We will have one slide throughout the process. We'll do a share screen. So at one point there will be a slide.
Great, thank you.
Okay. All right. Morning. Thank you everyone for joining us today. And this should be a gorgeous day. I love it because the sun's right here beating on me. So we're here to talk about the PPP. We've got a great panel of experts. We have Alex Gerken with Fifth Third Bank, Mike Hamp with the William Bond Company, and Jerry Benjamin with Raymond. So what we are going to do is each of these gentlemen is going to take a few minutes and give an update on what's happening with their respective areas. Maybe let you know some things that they've been hearing from their clients, maybe some issues, some advice that they have. And then we really want this to be an interactive session and open it up to questions. Thank you to all of those who have sent questions prior. The experts have that and they will incorporate that in their talk. But feel free at any point, if you do have any questions, you can use, there's a few ways. You can use the chat feature and I will monitor that. Or you can, there is a raise a hand feature. If you go to the bottom of your screen, there's the chat down there icon. You can click on that. The chat box should show up. There's also a participant icon. You can click on that and you'll be able to find your name, and by your name there's a raise my hand feature. We will also watch that and call on you. It is helpful if you keep it muted. It helps with background noise. And if you find you are having bandwidth problems, or if you feel like the speakers are going in and out, maybe try taking your video off. We've been told that that helps as well. So this is I think everyone on here is through Zoom. This is our first time using Skype for Business. So I'd love some feedback after this if you're watching through Skype for Business to see how that worked. And we also are on Facebook Live today. As with all of our sessions, we are recording these and we will have them up on our website. We will send you a link afterwards if there's anything you want to go back and rewatch or share it with a colleague or someone that could benefit from it. We'll send you an email with the link and it'll also be on our website. So with that, we will go ahead and get started, and we are going to start with Alex Gerken with Fifth Third Bank.
Well, thanks, Angie. Can you hear me okay?
I can.
Okay, perfect. Well, good morning, everyone. What an interesting time we are all dealing with. If you have talked to your banker, which I'm sure all of you have over the last month or so, and they told you they're enjoying this, they are most likely lying to you. If you've asked them a question or specific information about the PPP program and they answered either I don't know, or we're just not sure yet, or we haven't gotten clear guidance from the SBA, they are not lying to you, because that is fact in what we're dealing with. So I'm just going to take a couple minutes this morning and share with you a few things that we've seen as we've gone through the last couple of weeks here, and I'll focus probably more on the gap between round one and round two, but I really do would enjoy the question and answer session, so I'll keep my comments brief. I think I said the last time this kicked off, before we really started getting into round one, the program had just been announced, and I asked all the listeners to imagine your company and imagine that on a Wednesday, somebody comes to you and says, we're going to launch a brand new product on Friday, and 100% of your clients are going to be interested in it, and probably 90% or greater would qualify for it. How do you manage through that? That's what your financial institutions have been dealing with for about the last month. Round one was extremely bumpy, a lot of system issues with the SBA. So if your bank told you they were having connectivity issues with the SBA's e-trans system, that was fact through round one. Round two went live yesterday. The president signed the bill on Friday, gave the banks and the SBA the weekend to try to beef up their system to be able to handle the volume. What we experienced yesterday, and what I'm sure most of the other bankers that you'll talk to around town experienced was the system went live at 10:30 yesterday morning. They started issuing E-Tran numbers. At 10:34 exactly, the system crashed. And it was offline on and offline most of the day yesterday. So it was an extremely frustrating and not a very productive day for most bankers. However, there is light at the end of the tunnel. The reason for that, communicated directly from the SBA. There is a lot of demand for this product, as you all know. If you didn't get in round one and you're hopeful to get in round two, yesterday there were twice as many E-Tran users versus the peak of round one. So that was what led to a lot of the system difficulties yesterday. So we'll get into some of the forgiveness questions, I'm sure, towards the end of this. But really just wanted to focus on the fact that what you're hearing from your bank is reality. It's been extremely difficult. The rules have changed continuously throughout the process, which is one of the things back when we kicked this off the first time that both Eastman and Smith and I had referenced that, hey, we don't know all the rules yet, and the rules are subject to change and the guidelines are subject to change. And on that point, the SBA has issued a handful of updates to its interim final rule, which is sort of the guidelines that we're all playing by. They actually just issued another one yesterday that clarified some of the questions that were still out there throughout the program. So if you haven't reviewed that yet, I would encourage you to do that. We're encouraging all of our applicants to go out and review the interim final rule and just confirm that there were a few updates, and just confirm again that your business is still eligible. The eligibility questions still fall on the borrower, not on the bank to answer. So again, we're encouraging all of our applicants to go out and review the interim final rule, even if you receive funding in round one, just to confirm that you do deem yourself still eligible, and communicate that then back to your financial institution. So with that, Angie, I'll pause and let Mike and Jerry kick off their introductions, and then maybe we can field some questions. So happy to answer any questions, and thanks for letting me join you this morning.
Angie, I think you're still muted.
There we go. Sorry. There was one quick question, and it was to define the acronym ETRIM number. I mean, you weren't saying interim. Were you saying ETRIM number?
No, it's E-Tran. I don't know what it stands for, but it's the SBA's system that issues the SBA numbers. And when you get an E-Tran number, ultimately you're guaranteed funding under the program. It's ETRAN.
ETRAN. Okay.
And I'll look it up while Mike's talking to get you what specifically it means. No one's ever asked.
Great. And if you're looking that up, there is something else. Can you give the web address, the URL for the interim final rule? Maybe put that in the chat box for people.
Yep, I have it. I'll copy and paste it in the chat box if I can figure out the technology.
Okay. All right. And with that, we will go over to Mike.
Good morning, everybody. Thank you for joining us this morning. As Alex said, I think as we go through some of the Q&As, we're all really waiting for clarification. So I think what you're going to get here today is three individuals, kind of our take on the current rules, but we are all looking for a lot of finalization just as far as some clarity to them. My name is Mike Camp. I'm with the William Bond Company. And really what I wanted to kind of cover here in just a couple of minutes, I anticipate us spending the lion's share of conversation on the PPP loan and specifically the forgiveness calculation. But I do think there are a couple of other elements out there for people to be kind of aware of and kind of as they're planning ahead to kind of be thinking about. The first one is when we read all the original guidance, there was this separation between the PPP loan and kind of basically what's called the employer tax deferral. So as the employer is paying the 6.2% Social Security, again, this is the employer portion, the guidance would lead you to believe you had a fork in the road and you had to choose, do I want to go down the employer tax deferral, or do I want to go down the PPP loan process? So the employer tax deferral is basically the 6.2% from March 27th through the end of the year. You're allowed to retain the employer portion of the Social Security, and then whatever portion you don't pay half of that on December 31st, 2021, and half of that on December 31st, 2022. And so again, it really made it seem like there was a fork in the road between the two. Well, then there's some additional guidance that recently came out that applying for the PPP loan does not disqualify you from the employer tax deferral. Being approved for the PPP loan, actually receiving the PPP funds, does not disqualify you from the employer tax deferral. It is only at the point in time that the bank comes back and provides some level of forgiveness on that loan that the employer tax deferral is no longer allowed. So companies are allowed to retain that 6.2% employer Social Security up until the point that the bank comes back and provides some level of forgiveness. So if we had funding and we go the next 8 weeks, takes a couple of weeks to pull some paperwork together, provided the bank, a couple more weeks after that to actually provide back, here's what the actual forgiveness is going to be. We're looking at about 12 weeks or so, kind of at a minimum of employer tax deferral if a company so chooses. Now, I want to bring this to everybody's attention, but I do think as an organization, if you go down this route, then you've signed up for really some close cash, I guess, management over the next couple of years. There's really not a great mechanism. Once you withhold that 6.2%, and half of it is now due as of December 31st, 2021, there's really not a great mechanism that if you can't afford to repay December 31st, 2021, it's just not a good scenario. So it is available. It's great cash flow in times of need. But if you do choose to go down that road, it really kind of the onus will be on the company to really manage the cash to be able to pay that back. The second item is what's called the employee retention credit. This is another item that it's really exclusive of the PPP loan. You kind of go down the path of the employee retention credit, or you go down the path of the PPP loan. And this one is kind of that simple. You kind of go one or the other. The reason I bring this to everybody's attention is I think there's going to be a scenario where individuals potentially are going to try and get a PPP loan and eventually just not get it. Whether the money runs out in round 2, there's just going to be a multitude of circumstances. Hopefully 80-20 rule. Hopefully we're only talking 20% of the companies out there or less. But still, we're going to have some companies that wanted to try and get the PPP loan or just for whatever reason chose not to get the PPP loan. And so this employee retention credit, if you're a company that had less than 100 FTEs in 2019, this can be very lucrative. So essentially, it's a fully refundable tax credit equal to 50% of the qualified wages, up to $10,000 for all quarters. So if we do the math backwards, and also I guess I should say, since it's a 50% qualified, or since a 50% credit on 10,000 of qualified wages, that means the max credit is $5,000. And so it's $10,000 in a quarter. If we just think in terms of an employee making $40,000 a year, they're going to reach that $10,000 max each quarter. So if we didn't get a PPP loan and we have 10 employees and they're all making $40,000, then we can apply for this employee retention credit that's going to essentially be $5,000 per employee for the second quarter. And so that's going to be $50,000. And it's $50,000 in refundable credit that we don't have an SBA loan process to go through. We don't have a forgiveness calculation to go through. And the uniqueness that I just want to point out is that if you're over 100 FTEs in 2019, this kind of qualified wages, only the wages being paid to people who are furloughed. So essentially, you paying people to do nothing are the wages that qualify for it. If you're under 100 FTEs during 2019, then the way that we calculate the credit isn't just the wages being paid to those individuals that were furloughed, it's the total wages for the company. So it really does, it kind of lines you up to be $5,000 per person is a bit of a realistic target. Might take some of the second quarter to get there, but even somebody making $20,000 a year, if there's some degree of government shutdown, first and second quarter, then this can really be $5,000 per employee. The last thing I just wanted to mention is there is it was instituted as of September 11th. It's called Code Section 139 Disaster Relief Payments. That essentially what it's trying to do is trying to give a company a way to give employees benefits, like reimburse additional costs that they're incurring, and it gives the employer the tax deduction, but the employee does not pay tax on that income. And so because the entire United States has been declared a disaster area, this Code Section 139 strategy can work. And it's really geared for reimbursing individuals for the additional costs that they've incurred because they've either had a telecommute, because they have additional daycare. So think of it in terms of if we're a good business decision, we're already going to be giving somebody $1,000 as a hazard pay, as a thank you. You might want to consider doing that via the Section 139, because the company is going to get the same deduction as they would as a wage expense. But the employee actually is getting something a little bit more, because they're going to get the full $1,000 without needing to pay any tax on it. You would have to provide a little bit of documentation out to the employee, kind of coaching them as far as, okay, so did you incur additional daycare services, did you buy some more sanitation supplies for the home? Did you have to go out and did you incur some additional home office expense to be able to work from home? So you have to coach them a little bit as far as what additional expenses might qualify, and ask for some of those supports back so they kind of have the company has the receipts. Essentially, it is reimbursing for these additional expenses. But from our view, people who are telecommuting, we're going to have these expenses, and $1,000 might be nominal to some, but it's probably pretty significant to others. And I think you can get to $1,000 pretty quick. So I think these folks are going to have these expenses. And so if an employer wants to kind of reward the employee, it's just a way to do so that's tax advantage to the company, but yet not taxable to the employee. So there's just a couple of non-PPP items I just wanted to throw out there for the group, understanding what's on most people's minds is the PPP loan and specifically the forgiveness, but we just wanted to throw out those couple of non-PPP items.
Hey, Mike, what happens if you don't have the same number of full-time employees after 8 weeks? Will this affect the PPP loan forgiveness? I don't know if this specifically applies or if that'll, or Jerry might.
So I think when Jerry talks about the PPP loan and kind of that one slide and we get into some of the questions, I think that exact question is going to be covered then.
Okay. All right. With that, we will hand it over to Jerry.
Okay, thank you. I'm going to share my screen. So hopefully the one slide will be up and you can see it. This morning, what I really wanted to just hit and highlight is the loan forgiveness as it's been defined to date. And as Alex and Mike have both noted, there are still a number of questions and areas where we're looking for additional guidance. Number one, really, this actual spending is the spending that occurs during a defined measurement period. That measurement period is 8 weeks long, and it begins the date that you receive your PPP loan funding. And as we look at that spending, we're looking at allowable spending during this 8-week period. And just a couple of things to note. First, at least 75% needs to be used for payroll costs as defined. And that's going to follow the same approach that you used when you were creating your application. We're looking at gross wages, paid time off, employer paid portions for healthcare costs, employer paid portions for retiree, as well as any employer paid portion of state and local taxes on income. That's our payroll cost. But in addition, the SBA added 3 other areas that qualify as allowable spending. And those include mortgage interest, Interestingly enough, they define mortgage interest as interest on both real and personal property, not just a traditional mortgage as you would think of on real property. They also include rent on your real estate, your leased buildings, as well as utility costs. And again, they've defined utility costs a little more broadly in terms of, in addition to kind of the big three, if you think of gas, electric, and water, they've also added the cost for distribution, the cost of telephone, and the cost of internet. They do throw another item in there called transportation in the definition of utility, which they have not yet defined. And the only thing to remember with that is that we're capped at 25%. That's the ceiling that can be used for those three items that are non-payroll. And then finally, in this area on the allowable spending, until we get further guidance, we're recommending that people view this as a cash basis, that it won't be something that I accrued during that 8-week period, but that it's actually going to be cash expended. And I characterize that, this is not an SBA term, even though I've got it capitalized. This is just a Jerry Benjamin term of a loan forgiveness pool. This is my pool of my allowable spending. And then the Act comes back and has two specific adjustments to that. First, there's an FTE test, if you will, and they're looking at a reduction in employees. And so they're calculating a ratio, and that ratio is based on the average monthly FTEs during that 8-week measurement period. That's the numerator of our equation. The denominator looks at two specifically defined points in time, and the borrower gets to choose whether they use the period from February 15th through June 30 of 2019 or January and February of 2020. So for example, if you had your business had 20 employees in one of those defined periods, and that's what you've chosen, and during the 8-week measurement period you had 15 employees, average FTEs, your ratio is 75%, and that will be applied against my term of loan forgiveness pool. So if our allowable spending was $100,000 and our FTE ratio was 75%, the potential loan forgiveness is now $75,000. It's been factored down for that reduction in FTEs. Now, the Act does allow for a rehire exemption if those FTEs are added back by June 30, but again, we're looking for more clarification in terms of when they would have to be added, how they go into the calculation, and then specifically in the Act, there's some difference of opinion, but it also talks about restoring the compensation also by June 30. So again, there's some real unknowns that we're waiting to see clarification on. The other adjustment that we face is a salary analysis, and that's on a per employee basis. And the way it's written, if the employee during that 8-week period does not reach at least 75% of the wages that they did in the most recent quarter, which for all of us is going to be Q1, that amount, that shortfall, is a dollar for dollar deduction against the loan forgiveness pool. And then again, another character that we have to keep in mind, or characterization we have to keep in mind, is that those non-payroll costs, the mortgage interest, rent, and utilities, are capped at 25% of the total amount of the loan forgiveness. And then in the end, that balance that comes out that isn't forgiven rolls into a 24-month loan. The interest rate is, again, very favorable at 1. And the first 6 months payments are deferred. Interest will be accruing at that time, but there's a 6-month payment deferral. And again, I listened to what Alex said about the lack of guidance and the challenges that the bank are facing, and we still have that. There are areas of clarification we're looking for, such as what is the definition of an FTE? Someone mentioned I guess it was Alex that mentioned the clarification that came out recently in the SBA FAQs, and they have now defined headcount in terms of evaluating whether or not you cross the 500 employee threshold, but they're still using the same term of full-time equivalent employees, and they haven't defined that yet. You know, are they going to be looking at the Affordable Care Act definition, which would be 30 hours? Are they going to follow the same definition for the 500 employee basis so that it's really just full and part-time, regardless of hours worked? We're waiting for that. We're waiting for clarification on the exemption for the June 30 rehire of employees and related compensation costs as well. So that's just a very quick overview on loan forgiveness as we understand it today.
Hey, Jerry, I'm going to ask a few clarifying questions if I may.
Sure.
Okay, can you confirm? So you said transportation has been identified as forgivable, but it hasn't been defined yet what transportation is, correct?
Correct. In the definition of covered utilities, they do mention distribution, which makes sense in terms of there's a cost for that commodity as well as a cost to distribute it, and that's all part of your utility bill. That's allowable. They mention specifically transportation, but there is no definition yet that I've seen that clarifies what's included in that. I assume it has something to do with the delivering of the utility, the delivering of the commodity itself, but that's not defined.
Okay, and then in terms of utility, you mentioned phones. Does that include cell phones? It wouldn't be just landlines, correct?
Well, and again, that's one of the areas that those are great questions because they're the same ones we're waiting for guidance. They say telephone and they say internet, so I'd like to believe that cell phones will be included, but I don't, especially as it's become, you know, part of our standard communication. But today, we don't have a clear definition. I don't know, Mike, if you've seen anything that might address the cell phone question.
Yeah, so what we've been advising folks is just these expenses should really be normal and customary to the business. So whether we're spending the money on it or not shouldn't depend upon if it's going to be forgiven or not. So if we have cell phones, we're going to be spending the money. If we have a PPP loan, we now have funding to be able to afford those cell phones. And so I think it's more from a business decision. I don't think that's really kind of based upon the PPP loan. We should be spending the money based upon things that we need to spend. Now, if the question is, okay, but I just want to predict, right? I want to try and figure out the future. Jerry, I agree 100% with what you said as far as we're looking for clarity. I would say it's the arrows are definitely pointing towards cell phone costs being included in utilities. Originally, there was concern that would only be utilities that had to kind of go through the utility certification, which would only be gas, electric. And so then the fact that we have landlines, kind of there's some clarity for the landlines. I think it'd be very, very difficult to kind of come to some rationale that would include landlines, would include internet, somehow not include telephones.
Yeah.
We got several clients that now they're not open yet, right? But they're in that restaurant industry. And so a tremendous amount of expense in cable as far as getting kind of the TV streaming services there. So our position is, if it's a good business decision to expend the money, then continue to expend the money, and hopefully it is going to get forgiven. But if we had to place a bet, I think there's going to be a fairly liberal definition to utilities, and things like cable TV and cell phones are going to be included in that.
Yeah, and I would just add to that. This is Alex. Thanks, Mike and Jerry, for a lot of those details. The questions that are being asked through the chat feature are all the right questions. Frankly, we've faced them a couple thousand times here over the last several weeks. The one thing that I would just add, and it's probably important to note, that one of the first clarifying points that the SBA made after rolling out this program on April 3rd, and it was sometime around the 7th or 8th of April, so very early in the process, was the point here that's up on the screen, that the intent, and what we're encouraging our people that are calling, asking us questions, is to remember the intent of the program. The intent from the SBA and from the president and Congress and everybody else is to get funding and dollars back into the hands of the consumers, the employees here. So one of the first clarifying points that was made in one of the early revisions of the interim final rule was this: at least 75% must be used for payroll cost. So I completely understand why the questions are all being asked around the 25%, what's included in, interest and rent and utilities and all those sorts of things. But the fundamental goal of this program was to get money from the government, through the banks, through the businesses, into the hands of the employees. So while it says 75% here, I would be very careful and make sure that the first thing I did as a business owner was take care of that 75% rule. And I would err on the side of, maybe it's 80% or 85% or higher. Just as we work through and learn the rules and what specifically is going to be required for forgiveness, that was one of the very early, again, revisions or clarifying points was, hey, we get all the questions around this 25%, but let's make sure 75% of this program gets in the hands of the employees. So I thought it was worth pointing that out.
Yeah, that's a great point, Alex. And again, the limit on the spending, these are the categories that are allowable. So we've seen and had clients talk about other uses. Could I use it for perhaps addressing other debt issues, for example, or things of that nature? And that is not part of the allowable spending. The intent is the payroll, and then the SBA has added these other very specifically defined categories as allowable spending.
We've got a couple of questions that it seemed like are going down the line. If during the 8-week period of time, an individual isn't able to work, right? So they injure themselves, they're not able to show up to work. They are concerned for their health, so they choose to not show up to work. And kind of this kind of a penalty, if you will, that a company that would then incur on the forgiveness calculation. And I think that's a very, very kind of logical kind of thinking through that. When you read the 8 weeks and you read the rules and you say, okay, well, if my head count is down, if my level of compensation is down, then I might not get it all forgiven. The way that we've been thinking through this is that when you work through the math, an employer really is not penalized for an individual that doesn't show up to work. If that individual did show up to work and made $1,000, then we would get $1,000 via the PPP loan. We would pay $1,000 to that employee. That $1,000 would get forgiven. So at the kind of, when all the dust settles, the employer has no debt, no money left over, right? So it's kind of a zero-sum game to the employer if that employee stays around. If that employee doesn't show up to work, and so now we don't have this $1,000 of forgiveness because we didn't pay the employee $1,000. Well, the fact would be then we still have the $1,000. Right. So we as an employer can choose to, at the end of the 8 weeks, just simply pay that $1,000 back to the bank. So we're really no worse off by the employee not showing up because we didn't have to spend the $1,000. If the employee doesn't show up, and just for business reasons, we say, we want to hang on to that $1,000, and we like this notion of a 24-month 1% loan, then it still gives you the ability to hold on to the $1,000 and use that for the appropriate purposes over the next 24 months. So I can appreciate the question, because when you go through the math, it certainly seems like an employer would get penalized for somebody not showing up during that 8-week period of time. But when you just go through the complete math, right, cradle to grave, an employer really is not penalized for somebody not showing up, because if you don't get it forgiven, it means that you really didn't spend the money either. So hopefully that kind of clears. There's been a couple of questions out there related to headcount during the eight weeks.
Okay. All right. I did get a question, something we actually talked about on our kind of prep call yesterday is, so with the 75%, the payroll forgiveness, can you increase pay for employees during the 8-week period, especially if they've been working hard doing a lot of work?
Yeah, yes, I think you can, but I think it's very important that we characterize that pay specifically, because I assume we're talking about something that would be a temporary adjustment, and so you wouldn't want to throw that into their base pay as an add and a deduct later, but you'd want to specifically define the parameters under which that additional compensation would be paid. We have a couple of clients that I'm working with that have made a decision like that. One's using an amount per day that people are physically on site, and they're characterizing it as a form of hazard pay because they are coming into the factory environment and therefore, I guess, increasing the risk of potential exposure as they work among other employees. And so there's a per day. We've also got a client looking at a per hour, but the communication to the employees is very specific as to what this amount is for, that it is for a specific time period with a firm start and a firm end date. And then we're segregating that in another payroll code so that we can highlight it. So that's the guidance we've been giving to our clients. And you know, Mike, you may have some other clarifications as well, but I think, yes, you can absolutely have a payroll adjustment.
Yeah, I mean, the only additional item, and I mean, I think, Jerry, you kind of said this, I think in all of this, and I think Alex kind of comments are in line with this, we just need to make sure that we're being reasonable during that 8-week period of time.
Yeah, yeah.
If we're giving somebody a 10% bump during the 8-week period of time as hazard pay, as a thank you, as a, hey, we're in this together, you know, it seems to be, just one person's opinion, seems to be reasonable. If somehow we want to double that individual's pay during that 8-week period of time, then you know what, right now there's no rules against that. My suspicion is by the time we get to the finish line, there will be rules to prevent employers from doing something like that. So I think it's got to be reasonable. It's really got to be within the intent of the law.
Yeah.
Yeah, Mike, I think that's a great point because, like we've said numerous times already on this call, the rules do tend to be clarified and changed throughout the process. In fact, on that point, when Fifth Third funded these loans in round one, we funded almost all the ones we did in round one already. Our specific, the banks had some flexibility on which actual loan note document that we used. Our document included no language of forgivability, mostly because we didn't feel like we had enough direction from the SBA or from the agency on what specifically was going to be required from the borrower and then validated by the bank. So our note doesn't even reference the forgivability of the actual loan, again, because we weren't real sure. We didn't feel like we had good guidance on what we needed to do. Therefore, we didn't want to document it as such in the actual note. Now, clearly, we're going to follow back up with all of those clients and ensure the forgivability. That's why this is such an exciting opportunity for small businesses. But there are still a lot of clarifications that need to be made on those points. The entire agency was focused on getting these dollars out the door quickly. In fact, in the first 13 days of round one lasted 13 days. The SBA did more loans in 13 days than they had done in the prior 20 years combined. So the volume was insane, and they were all focused on getting round one, getting the money out the door, and then turned to focus on round two and getting that money out the door. They really haven't sent a whole lot of clarity to the financial institutions around forgivability yet. So all these are great questions, and again, I led off with, we just don't have clarity or we haven't gotten good guidance yet. We will get it. My guess is it'll start to come out as, the round two money starts to run out. We'll start to get more clarification around what exactly is going to be required from the banks.
So it sounds like these might be weekly PPP meetings we might be having here.
I never thought after 20 years in banking, I would focus 100% of my time on SBA lending, but that's where I am today.
Yep. Quick, your thoughts on when you were talking about kind of the hazard pay and making sure you don't like double salaries. What are your thoughts on retention bonuses? Do you think those would qualify?
See, to me, I think there's a chance, and maybe I'm being overly conservative. I think there's a chance that in the final rules that they could take the term bonus and somehow exclude bonuses during the 8-week period. So I just don't see any benefit in calling it a bonus. I would, if it makes good business sense and it seems reasonable, I would characterize it as hazard pay. I think that there's a lot of public companies out there that are paying hazard pay. So I think it's a very real concept. And so I would just encourage people to call it hazard pay if it makes good business sense. If they're saying that, yeah, in reality, it's kind of a retention bonus, I guess I get it. And maybe I'm being overly conservative. I just think that word bonus could get caught up in some of the definitions on a go-forward basis.
Yeah, I think Mike's right, and again, it goes back to that intent, the intent of the act. We have a couple of clients who have applied and received the PPP loan. Before that, they had made a decision based on the longevity of their employees, that in spite of and their skill set, that in spite of that employee not working, they were continuing to pay their salary, and it was for the purpose of just, number one, protecting the employee because of the relationship that this owner has with his colleagues, but also to keep skilled labor engaged and staying with them. So this was done before the PPP loan, but in some ways you could argue it was to maybe to retain them or keep them whole. And as we move into the PPP loan period, I think that compensation, characterized correctly, is an allowable expense, and especially when you think of the intent, which is, as Alex so clearly stated, the federal government is using banks and employers to get funding and funds into the hands of employees, into the hands of consumers. So it's important to understand the intent and the purpose, and as Mike really said very well, to stay within good business practices.
Again, I would add to that, it's also important to remember what documentation you've provided to the bank during your application process.
Yep.
And I've been doing this a long time. I have a fairly extensive history of SBA lending, and I always caution folks to err on the side of being conservative. And you've supplied documentation and support for the loan amount from historical records. And I would say, I always try to talk to folks, would you want to read about this in the newspaper? And if you think about some of the questions that are being asked, and they may very well be allowable, but they also, things are subject to change. So you provided documentation based on historical numbers to the bank, who took that calculation and then provided you a loan amount based on the SBA program. On the backside of this, the bank will then ask you for documentation. If there's something that really stands out, for instance, you triple everyone's salary, or you provide a $10,000 bonus to somebody that never made anywhere near that bonus before, at some point, someone's going to say, was that reasonable? And there was no documentation or support of that from prior year's records. So why? Why now? Is it because, quote unquote, you got free money during this program? So I would just say that, again, the intent of this system was to provide wages for employees for an 8-week period. And I would be very cautious and careful that I did my best as a business owner to match what I've done previously to what I do today. Again, today it's gray. The area is very gray. But at some point, you're going to have to defend either to the bank and then ultimately through the bank to the SBA your decisions and where the money was spent. So to the extent you can go back and show that I've done this before and it matches what I've done before and it's supported that way, I think that's your best route to ensure forgivability on the backside of this program. Something I thought was worth clarifying.
Thank you. I had a few other questions sent to me asking for clarification. So if you don't use 75% for payroll, does that mean none of it's forgiven? Is that what you were saying?
No, I think.
No, but go ahead, Mike.
Oh, I'm sorry. What the calc is saying, if you, whatever amount is going to be forgiven, 25% of that cannot, the other three categories cannot be greater than 25%. So if we get $1 million and we spend $1 million on payroll, then we get $1 million forgiven. If we get $1 million, spend $800,000 on payroll and $200,000 on the other three categories, then the total forgiveness is $1 million, and the $200,000 is 20% of the total, so it doesn't exceed the 25%. If we get $1 million and happen to spend $400,000, then I guess I'm not doing my math here quick. It's not quite 100,000. Let's kind of keep it simple here, right? So spend 400 on payroll, then we're only going to be allowed 125, maybe, right? 125,000 on the other three categories. So you're never in a position where the payroll isn't forgiven, and whatever you pay on payroll, per the guidance right now, every dollar that you pay on payroll gets you 25 cents, then you can pay on the other three categories. And I get that math doesn't work out quite, but I mean, I guess we get the concept. So it's not that if we don't pay 75% on payroll, nothing's forgiven. Whatever we pay on payroll is going to be forgiven.
Right.
Thank you for the clarification. And then here's a question from earlier. So if you need a refresher, I'll ask about what we were talking about. I'll ask Molly to jump on and clarify it. She asked, is the point of segregating, is it to ensure they do not claim entitlement after the period of time?
The segregating the payment, or I don't follow the question.
Yeah, I'll just ask. I mean, when you talk about segregating the hazard pay that you give to folks,
Yes.
and you segregate in your records, I'm thinking is a big reason for that, so that after your 8-week period are over, those same employees, after the crisis over, those same employees can't say, hey, you gave me this 10% bonus, I'm entitled to it going forward. Is that the point of the segregation, or is there another reason to segregate?
Well, it's essentially, again, what we're trying to do is define the parameters and keep it separate so that it's very specific to that time frame and that occurrence and that reason, whether it's the 8 weeks or not. The one client I have that is doing the hazard pay is tying it to the time that Michigan is under a shelter-in-place order, which now goes till May 15th. So again, they're being very specific on a start date, a stop date, and we're calling it hazard pay. It's a union environment, so again, it's not gone into the base wages. Someone can't make a claim that by your conduct you really created a wage increase for everyone that needs to now be followed on a permanent basis.
Thanks. I'm going to ask Bill Hitch,
Yes.
if you want to unmic. You had kind of an in-depth question. Go ahead.
Can you hear me?
I can hear you.
Okay. This is probably for Jerry, but it could be for any of them. It's a two-part question. I applied for the loan on the morning that the PPP was announced, like 9 a.m. I still haven't heard really from the bank. They haven't asked for my information. I've had repeated requests of the loan officer, and I don't get any answers. So that's one thing. I wonder why that is. Do they treat like a really small person like me differently somehow, and the big boys are getting the money and I'm not? That's one question. The second question is, I have all contractors, and they work in my office, but then they went to their homes and worked, which fortunately we can do. How does this hourly wage thing work? Because I work on a flat fee for services rendered, even though all of them are full-time. We don't define full-time by an hourly calculation. How does that work?
Okay. Well, from the, I don't want to, we've got Fifth Third represented here with Alex, and maybe he can talk about the situation. So what you're saying is you haven't been able to determine whether they've even approved your loan to forward to the SBA.
Supposedly I got a number from the SBA, but there was no number in the email. That was the only communication I got. I don't even know if it came from the bank. It came from somewhere. But nobody's followed up. They said that they would ask me for the information. Nobody's followed up for my data, to demonstrate that I'm eligible for this.
Yeah, so I'll try to address that. And I'm specifically not going to ask you who you applied with, because every bank acted a little differently, had a little different strategy. I mean, if you think about it again, we assumed 100% of our businesses, clients, regardless of how big they were going to be interested in this, and probably 95% would qualify. So each bank handled their expectation around volume differently. I can only speak on behalf of Fifth Third and what we did. We allowed folks to go into our electronic portal, 53.com, and express interest in the program. In other words, it said, are you interested in applying with Fifth Third, yes or no, for our retail-based small business clients. Once they did that, we then had a field of folks calling back those businesses over from basically April, probably 8th or 9th until yesterday, calling those businesses back, collecting information, making sure again that the clients express eligibility. It's not on the bank. So that process took 3 weeks, and frankly, we got to almost everyone that expressed interest. We did not get to them all. It was just, frankly, man hours was impossible. But each bank handled that process very differently. So we did have some clients through that process who thought by expressing interest in the program that they actually applied. Through Fifth Third to apply, you had to collect all the information and go through the actual application. So again, I don't know who you applied with, but if you have an E-Tran number, which again is the magic here, that means that there is funding set aside at the SBA. Your banker should be doing cartwheels, calling you, telling you that you have that number, because that's the number everyone's looking for. If you haven't heard back from them, I don't know what to tell you. We certainly, Fifth Third called all of our clients, or our clients got an electronic notification that their loan was approved and cleared the SBA system, and they got an E-Tran number. So again, all banks handle that differently. So I don't know exactly what state you're in, but I would call the bank back and make sure you get a clear answer on whether you do or don't have an E-Tran number. So I'll address that part of your question and let Jerry do the back half.
Yeah. So going to the second point, I just want to get a little more clarification. So Bill, are you saying you don't have employees, but you use 1099? Okay.
Yes, that's right.
So, and your business is issuing 1099s to those contractors.
That's right.
Right. So as I understand the regs, that compensation is not included in the determination of your loan amount, because the independent contractor can file themselves as on a Schedule C or 1099 individual. So do you have any W-2 employees? No. Okay.
Just so you know, at the time that I applied, they didn't have that information. They said contractors would be involved, and then they never got back to me to let me know that that's not the case.
Yeah. Are you a Schedule C?
Yes.
Okay. I really think that probably would, Mike is probably a little better in terms of addressing the nuances. But as I understand it, again, a Schedule C individuals is eligible to apply for the PPP loan. You would be subject to some of the same requirements. So, for example, income in excess would be capped at $100,000 from an exclusion standpoint, but up to $100,000 worth of income. I'm not as clear on terms of inclusion for your medical or retirement. Mike might know that a little bit better than I do.
Yeah, they actually came out with an FAQ that I just can't put any logic to the rationale, but an employer paying an employee the $100,000 is really referring to cash compensation. So if I pay somebody $150,000 and I incur $10,000 of health insurance, then what really goes into the math is 110.
Right.
150,000 of cash comp comes down to 100. I pay 10,000 of health insurance, so I get to count 110,000 both in the calculation that was multiplied by 2.5 and in the payroll cost for my 8 weeks. When they came up with the FAQs specific to Schedule Cs, it is very, very clear in black and white that a Schedule C individual is limited to $100,000, period. Even if they are paying for their own health insurance, it's just not on top. I can't quite, and even when you go down to the next layer of this FAQ, where they talk about a Schedule C that has employees, it specifically has the same verbiage over again as it relates to Schedule C. And then the employees, they get to include the 100,000 plus like 401k contributions plus the health insurance. So I can't quite figure out the logic. We also had another question here in the chat that I think is really, really relevant here, just as far as kind of thinking through the mechanics of how a Schedule C individual works. Because Jerry is 100% correct, Bill. Unfortunately, it creates a bit of this cumbersome system where you're not filing for all the 1099 individuals under one business. All those 1099 individuals are filing independently as their own businesses. So if we have a business that is a Schedule C and does not have any employees, it really is based upon your 2019, essentially self-employment income, right? And so even if you have not filed your tax return, they've come forward with guidance to say you are going to have to mark up a Schedule C, have your accountant do it, try and do it, get coached to do it. We've got to pull together somehow just kind of this extracted out Schedule C from your 19 return and provide that. Then essentially it's the profit from your Schedule C that's going to go through the math. And it's just capped off at 100. So if my Schedule C in 19, very likely it's a cash basis taxpayer. So if my Schedule C in 19 made $50,000, then we run the $50,000 times the 2.5. If my Schedule C made $150,000 in 19, then we run $100,000 through the 2.5 times, right? So if we have, what is that, $8,333 a month, right? So we're going to get about $20,000 in PPP loan if our Schedule C makes $100,000 or more. Then, to Jerry's point earlier, barring any additional guidance, it is cash basis during the 8 weeks. So the question really kind of got after, well, I got a Schedule C, but I'm not doing a lot of distributions. How exactly does that work? Well, you got a Schedule C that qualifies for a $20,000 loan based upon the 2019 earnings. You're going to get $20,000 funded into your checking account from the bank based upon how the PPP kind of theoretically should work. Our recommendation would be during that 8-week period of time, take $16,000 out and put it into your checking account. Pay yourself that $16,000. And best I can tell, if when all the clarification comes out, what should happen in just round terms, if just a single Schedule C person were to kind of go through this process, they're going to end up getting $20,000 from the bank, putting $16,000 of that into their checking account. And when all the dust settles, they're going to end up with a $4,000 2-year 1% loan. And they kind of choose what they want to do with that. But I do think it's a critical point that it's your 19 income that determines the 2.5.
Right.
But I would make sure you disperse the money out of the business account and into your personal account during that 8-week period of time. So you kind of meet this kind of cash requirement that you paid yourself during that 8-week period of time.
And that's adjusted gross income. That's adjusted income, not the gross amount you made.
Yeah, that is the revenue minus all the expenses. That is the net profits of the Schedule C.
Yeah. Okay.
And just to add to those comments from the bank's perspective, what we have been doing for those Schedule C employees in again, documentation and support historically, we've been collecting the 2018 Schedule C in most cases. We've also then asked, to Mike's point, we've been directed by the SBA to ask for a 2019 Schedule C, even if the taxes aren't filed, to draft one up. And then we've also been attaching to most of those a one-page profit and loss statement from 2019, just so that we, again, have 3 data points then to show on a go-forward basis that shows a little bit back to that consistency and the fact that we've got history to prove that what we're doing kind of matches what we're going to do with the receipt of the funds. So that's how we've been documenting that at the bank level, at least at Fifth Third. Good questions.
Yeah, great questions.
Shifting slightly, I had a question asked a little while ago. I wanted to make sure I got to this. Looking for recommendations when you have salaried employees who are also on commission sales. So their sales are down. Do they pay the average they were earning for the past 6 months in comparison to last year, or do you not consider that commissions part?
I guess our advice would kind of go back to, first and foremost, just make sure it's a good business decision. And so if from a employee retention, from a, hey, we're in this together, right? We're all on the same team. Heck, if an employer wanted to say, I've got a PPP loan, I'm going to pay the individual's commissions as if it's normal times because I'm going to get it forgiven. I mean, there's unfortunately some risk here because they just have not come out with a clarification. But I think if an employer got a PPP loan based upon kind of historical commissions, because commissions would certainly be included in payroll costs.
Right.
So if they got the loan based upon 2.5 times normal times, and they said, I just want to make the individuals whole during the 8 weeks and paid them their kind of their full commissions that they kind of theoretically would have gotten if COVID hadn't happened, I would expect that that's going to be a forgiven portion, right? It's ordinary, it's customary. It's not like we're kind of gaming the system or taking advantage of it. I would expect that paying them full commissions would be forgiven. So I kind of go back to, I don't think it's as much maximizing the forgiveness as it is just kind of doing what's right for the employees and kind of doing what's good for the business.
What about an owner's personal investment? Can that be paid back with this?
That was one of the questions that was kind of given to us ahead of time. The intent of the whole program is to fund payroll. So if the owner, if the owner has the, like we're saying, Schedule C, $100,000, and they want to pay themselves the proverbial $16,000 kind of in this example, if they wanted to pay themselves $16,000, so they received 20, they got $16,000 forgiven. But then from an accounting standpoint, they wanted to just contribute that $16,000 back in and essentially treat it as kind of buying the business. Yeah, I don't see why on the back end you really couldn't do that accounting, but I think that we're really getting into semantics. At the end of the day, what's going to be forgiven is really based upon the self-employment income that individual can justify and is receiving during that 8-week period of time, not an equity transaction.
Right.
Okay, and I know, Cassie, are you still here? If you are, I know you had a few questions. I think we covered them, but I wanted to give you a chance to kind of ask. They were a little bit more in depth. Are you still online?
Yeah, I'm hard to hear on my glasses off. I'm the person that has the injured worker, and Mike, I think you said if they're not here, then you're not losing anything because you're not paying them, but that's not true because I only had 2 full-time employees and I still have to keep 2 full-time employees, and I have to spend 75% in order to get it forgiven. So in order to meet I have to have 2 FTEs and that I have to spend 75% of it to get it forgiven, I have to pay somebody else. Plus I need somebody else in here. So we're a small company. So I promoted one of my part-time people to full-time.
Okay.
While he is on, I mean, he threw his back out, so who knows how long he'll be out. So his pay will be less, but her pay will be significantly more. But he, in my first 8 weeks or even last year, was the person that was working full time. So when you look at that, you see what I'm saying?
So, but is your example, because our read right now, we're still looking for classification, but our read right now is that these rules really aren't on like attached to a specific employee. So if you did replace that employee, then if your FTE is the same during the 8 weeks as it was before, or if like the total compensation paid is similar. So are you saying that at the end of the 8 weeks, you're only going to have one employee, and at normal times you'd have two? Or are you saying no, you're because you had to promote somebody, you're still going to have two FTEs?
I'm still going to have two FTEs. However, Mark himself on that third line where it says every employee that makes less than 75% of what they did in the period, then that part won't be forgiven. But I actually had to pay that money to Linda.
Yeah.
You know what I mean? So it's not like I'm not out the money. I'm out the money because I had to pay it to somebody else.
Yeah. So our interpretation, that's going to be kind of what we call class of employee. So the fact that you didn't pay Mark, but you did pay Sue, our interpretation right now would be you're not going to get penalized for that. If during a normal 8 weeks, you'd pay $10,000 in payroll cost, and you're still paying $10,000 in payroll cost, it's just to a different group of employees. Our current read would be you're not going to get penalized for that. It's not like attached to that individual person. It's an FTE calculation, and then separately it's a level of compensation calculation. It's an excellent question, because definitely there's a little bit of concern out there, because I'm taking some liberties in kind of interpreting the rules that I'm reading. I can clearly see what you're saying, that if you just read it very, very literally, it would make you think that if somebody left and you weren't paying that person, that you really can't cure that. We've got the June 30th kind of concept still that we haven't really thrown out there all that much, that FTEs and level of compensation can be cured by June 30th, and we're not supposed to have any sort of reduction in the forgiveness. So that's kind of another element that it leads me to think what I'm thinking. I think the intent is to prevent employers from mistreating employees.
Yeah.
That's
To the extent that it was an
yeah.
employee that chose to leave, but you still needed that workforce and you replaced that individual and were paying them at a comparable level, my expectation is you're not going to have a reduction in your forgiveness.
Okay.
Now, I was thinking about a scenario that I do think a company could be harmed if we had two employees and pay them $10,000 a piece, and one person decided that they didn't want to come in. So now that $10,000 that we would have given them, right, I would go back to what I was saying before, that's kind of a push, because we don't get the $10,000 forgiven, but yet we're going to still have the $10,000.
Right.
Under that scenario, I think that you're only going to be eligible, right, for 50% of the forgiveness during that 8 weeks. So
Right.
the $1,000 for the person that didn't show up, it's a push. But for the $10,000 for the person that did show up, then I do think you can get kind of whipsawed based upon how the rules are written right now, that somehow you scrape by with one person versus two. You did pay that person $10,000, heck, maybe even paid them $15,000, right, because they're working extra hard. But based upon that FTE calculation, you're not going to get a haircut on the $10,000 you didn't pay the employee, just how the math works. But I definitely see your point if you're saying that, wait a second, I am going to get a haircut on the money that I did pay on the one employee that was still there. So that, I mean, that point's definitely valid. I could see where that, hopefully that's an unusual circumstance, but I can see where that could happen. I mean, if we have 90 employees and we get by with 99, right, obviously the math is a little bit different. But with companies that have just a handful of employees where every person is such a huge percentage of the FTE, I can see where that can just be a bad outcome.
Yeah. Okay. Cool. Thank you.
Does that help?
Yeah.
Okay, I'm trying to go through the questions here, making sure we get everything covered. There was a quick, can rent be prepaid?
So again, I think we kind of follow, and Mike touched on this in terms of our regular business practices. So yeah, if during that 8-week period, and if we're on a monthly rent, I certainly think we want 2 months worth of rent in there. Where you start to, I think, go out of bounds if someone were to say, well, I just got my loan, why not pay 12 months and prepay it? I mean, that would clearly kind of fall in the egregious. That's not what it was intended to do. So I would steer clear of something going out that far. I think, again, if you stay, as Mike said, if you stay within your historical practices, you should be well within the guidelines.
And here's a question for Alex. I know the banks are swamped and putting in a lot of work on this. Viewer was just curious, what do the banks get out of this?
That's other than a whole bunch of sleepless nights and a lot of headaches. No. And last Friday, we had a lot of clients, 2 Fridays ago, I guess, had a lot of clients who got left out calling and yelling at us. But in seriousness, the response to that is the banks get a lender's fee associated with each one of these loans. If I remember the grid correctly, if it's under $500,000 loan, the banks get, I believe, 5% fee. If it's under $1 million, I think it's 3%. And if it's over 2 million, excuse me, if it's under 500,000, it's 5%. If it's from 500 to, I believe, 2 million, it's 3%. And if it's over 2 million, I think the banks get like 0.5%. There's some fee grid that's associated with it. And then the 1% interest is obviously forgiven, but it is ultimately paid to the banks. So to put it in perspective, the fee income is okay from a bank's perspective. It's not great, but when you think about all the banks and all the corporate resources that were allocated to delivering on this over a 3-week period, it's not the most highly returning asset on the bank's books, but it is obviously a good service to the community. And probably what the banks get more than anything at the end of the day is if this works and it returns, the market and the stock market, and it gets people back to business and turns kind of is a stimulus for the economy. I think that's ultimately what the banks get out of it, more so than anything direct. So I hope I answered that. There's a little bit of fee income, but ultimately it's it's just something that we're being asked to do.
Well, thank you. This is Scott Grove from Six Discipline. You guys are doing a great job. You helped us. I know you've helped a lot of our clients, and just it's a lot of work. And I know it's been pretty crazy time. And I was just curious about what you guys are getting out of this with all the effort and work you're putting into it. So thank you.
You're welcome, and I appreciate the question and the comments. It's I think if you were asked most bankers over the last 3 weeks, I personally put in more hours in the last 2 weeks. There were a lot of days I was 16, 17-hour days, and ultimately I think we're doing our best to deliver for small business, and I appreciate your comments. So thank you. By the way, I love your background.
I got a 10:50 tea time if you want to join me.
I'd love to.
I'm kidding.
Great. So there was a question on the chat that you can all read about explaining the cash basis with regard to employee benefits. Mike is going to address that question now.
Yeah, so kind of conceptually, cash basis versus the other version is accrual basis. So if a business or an individual, right, accrual basis, really you record revenue when you earn money, and you record the expenses when you incur the expense. Versus cash basis, you don't record the revenue necessarily when you earn it. You only record it when you actually receive the cash. And for like the accounts payable, you don't record the expense when you incur the expense. You record it only when you pay the cash, right? So we've got this very literal reading of cash basis that cash received, revenue, cash out is expense. So then we take this to the PPP forgiveness, that barring future guidance, our interpretation is the 8 weeks is a cash basis concept, that expenses that are paid within that 8 weeks are going to qualify. So, I mean, as we can see, this question really relates to some benefits, some payroll type items that are traditionally, they're not really paid in every single payroll. I know this is going to be cumbersome and it's going to kind of feel like a waste of time, but our current advice is, barring any additional guidance, make sure that all these expenses are actually paid within that 8 week period of time. We're talking about calling up the payroll company and making sure you run payroll on that last day of the 8 weeks, right? It's going to be additional fee for that additional payroll run, but make sure that you're running a payroll on that last day of the 8 weeks. If we have retirement benefits that traditionally accrue throughout the year and get paid in lump sum at the end, my heart of hearts, I do think there's going to be some mechanism to limit paying a full year's worth of benefits in the 8 weeks. I just think that there's going to be something that is going to limit that. But trying to calculate what portion of the benefit, a retirement benefit, we're also talking about like some safe harbor profit sharing. Any benefits that we can just, as kind of cost accounting, right, we can attribute to that 8 week period of time. Current read is, if it's not actually paid in that 8 week period of time, it's not going to count. I know it's going to seem cumbersome, but our advice is do everything you can to, via your own kind of writing checks to the employees and or the payroll company, do everything you can to actually spend that money during the 8 weeks. As Alex, Jerry, are you guys seeing anything different?
No, that's the guidance we're giving. I've got some clients, and it's the situation that you exactly described, Mike, where the contribution to the retirement plan is done at following the finalization of the year-end numbers. So it will typically happen in late January, beginning of February. And so again, if we look at the intent and the fact that those costs were included in determining the payroll costs for purposes of the loan application, that again, a pro rata share of the expected or calculated contribution for an 8 week period, we're recommending they look at paying that in that 8 weeks. Again, really staying within the intent.
Yeah, I would just, I said early on, where things are still being clarified, there's a lot of gray area, and to be conservative. So I'll stay consistent with my answers there. There are some things we know and some things we don't know yet. And again, I believe once the agency shifts from a mad rush to get as many E-Trend numbers and loans out the door as possible, I think some of this will start to take shape and take some clarity over the next few weeks. But I agree with, Mike and Jerry both on how they're interpreting that. But again, the devil's in the details, and we just don't know everything yet. So to the extent, I would say stay very close to this. And some folks that already have their funding are asking these questions because they're like, hey, my clock already started.
Exactly.
So I think the guidance and advice you're getting is the right guidance and advice. But so the clock has started for some, and just, again, be as consistent as you can. And again, remember the documentation that you provided to get the loan approved. And to the extent you can stay close and consistent with that, I think at the end of the day, your results will be, positive. Again, along the lines of the rules keep getting clarified again, this is the classic example of changing the tires while the bus is moving for everybody. Just got an email a minute ago stating that Mnuchin was out in the media today saying every loan over $2 million will receive a full audit for how the questions were answered on the application. So again, I've gotten probably a dozen emails already for some of my bankers and from some of our clients saying, hey, this wasn't part of the program we signed up for. What do we do? you know, again, the onus is on the borrower who answered those questions. And now it looks like deals over $2 million, loan amounts over $2 million. It says, quote unquote, will receive a full audit, whatever that means. So,
Right.
you know, clarity will continue to surface here as we go forward.
One more addition to that also, if I could, Alex, and the rest. Again, we just applied for less than a $200,000 loan. Many of our clients less than $1 million, but I'm talking once we got approved, and this was what, I don't know, 2 weeks ago on a Friday. I can't remember the dates, but I'm talking, yeah, phone calls twice a day to our banker. And it came through. So it was greasy, what do they call it? The greasy wheel.
Yeah, the greasy gets the grease, yeah.
And we were on them. So same like William Hirsch, who's not at his seat anymore, but and all the other ones, keep after. Once you get the approval, man, just call and call and call. Sorry about that.
Yeah.
You know, you got to do it. So, and that became our
part of the deal.
main priority, unfortunately, for a period of time. So
That's a good point.
I had one clarifying question someone asked. Just to clarify, payroll expenses such as payroll fees and taxes paid in, does that count as the 75% of payroll costs?
Payroll taxes, no.
Yeah.
Unless, specifically though, if it's a tax on state and the employer paid portion on state and local income tax, yes, but federal, no.
I think there has been some kind of confusion on that as far as if you pay somebody $1,000 and there's $200 of taxes that are being withheld that are really employee taxes, well, you still paid that person $1,000. So you still get to pay the $1,000. It's the FICA, it's the employer portion that is not included in the payroll cost.
All right, thanks. I think there's one more I missed. Pete, if you're online still, I think I see you. Pete V, you might want to jump in. You had a question early on about can you deduct your PWC? Do you want to clarify that one at all? Or ask that question? Okay, well, if you get this and can jump on and clarify, go ahead. In the meantime, if there's anything I missed, I think a few more coming in down here. Our company still has a defined benefits plan, pension plan. Can we include our required contribution to that plan as payroll costs?
It's paid within the 8 weeks, yes.
Okay. And then one further clarification, CPA fee for payroll, does that file under utilities?
Say that one again, Angie.
The CPA fees, would that fall under utilities?
It's certainly a necessary expenditure.
I have not seen that one get defined as utilities yet. There has been a couple of questions out there that really relate to, so somebody's working from home and they're incurring some additional like internet costs or whatnot. So I think the category of cost is kind of a given, right? So it's internet. So we believe internet's going to be included. So I think whether an employer can include that in their cost or not has everything to do with if they are paying for it. So if the employer is reimbursing the employee for that, that then becomes an employer internet cost, regardless of the actual address that the internet was providing service to. So I think it really kind of comes to who's paying for it. If the employee is incurring additional internet cost, but not getting reimbursed for it, then I don't think it can get included as additional cost. But if the employer is paying for it, it should be included in the utility cost.
Okay, and there's a question, can you clarify what payroll taxes are not included? You said that earlier. Can you just clarify what you?
Yeah, so the 6.2% employer Social Security, and then the additional 2% on Medicare. So the employer federal taxes are excluded from payroll cost.
Okay. Thank you. And I think that takes us pretty close to our time. So I wanted to wrap up. If there were any further questions, feel free to email them to Emily or myself, and we can try to get them answered for you. Thank you so much. I know you gentlemen are working tirelessly in trying to read through this. It's coming quickly, and a lot of it's still uncertain. So we really appreciate you taking your time, because I know the goal for all of us here is to help the local businesses, to help the family and privately held. We want our community and our area to succeed. So we very much appreciate your time, all that you've given us into the center. Again, like I mentioned earlier, this is being recorded. We'll put it up online. We'll share it with you. We are doing another webinar on Friday. You should get an invitation today, talking about what happens for our local economy after all this is over. What are the opportunities? How might this affect us, just kind of looking into the future. So we will have more information on that out to you today. So thank you. Thank you everyone for attending. Thank you everyone on Facebook Live. And again, thank you very much to our presenters.
Thank you for having these, Angie. These are very important.